All right, the Fed cut rates by a half a basis point last week. So what does that mean going forward? And as you can see in the bond chart, you can see that everything kind of leveled out. In fact, I'm going to point to look for the green arrow. I'm going to point to the day that the Fed actually cut rates, and you'll see that the bonds dropped. And again, when the bond drops in yield, that's what pushes mortgage rates up. So, contrary to popular belief, the Fed does not set mortgage rates. And this is proof. We have been seeing rates improve. Rates have been dropping since July 2nd. And the Fed hasn't done anything until last week. And they cut rates by a half a point. And rates have pretty much stayed the same or actually got slightly worse. That's because the Fed, when they cut the rates, it impacts short-term spending, short-term loans like credit cards, car loans, treasury loans that are 10 years or less. Anything that's a 10-year note or less, that's what it's going to impact. A mortgage is not a short-term lending instrument. It's a long-term investment. So that's why it doesn't directly impact it. Bonds, which drive mortgage rates, are driven based on inflation data and economic conditions and reports. So the Fed has a little bit of influence in that with their monetary policy, but it doesn't mean when the Fed goes out and cuts rates by a half a point, you're going to see that in mortgage rates. It just doesn't work that way. We've been seeing that rate drop happen since July 2nd. We've seen rates drop 2 full points since they've started dropping. So you gotta take that into account and understand the big economic picture and how everything comes together. So going forward this week, we've got some more PCE, more inflationary index information coming out on Friday. We've got the pending home sales coming out. We get some appreciation data. So we've got some big potential market movers with reports coming out this week. Overall, we continue to expect that rates will continue to drop, and the opportunity is going to be there. Buy now while you can lock in that lower purchase price before everybody floods back into the market. And when everybody floods back into the market, when the rates drop into the fives, now all of a sudden the bidding wars will start to happen again, and you won't be able to get a seller concession. You won't be able to get the seller to pay for closing costs. You're going to pay more for the house. And even though you win the battle on getting a lower rate, you're going to lose the war on paying more for the house. So buy now, lock in your acquisition cost, refinance later when rates drop. Call us if you have any questions. We'll talk to you next week.